House prices across the United Kingdom are falling at a pace few expected, and the shift is shaking the foundation of what many once believed was the safest investment on earth. Streets that once buzzed with bidding wars are now lined with for sale signs that refuse to come down. Families who stretch their budgets are watching their home values slide every month. What's causing this sudden collapse? It isn't one event, it's a chain reaction built over years. From soaring mortgage costs to changing lifestyles, this is how the UK housing dream started to crack wide open.
Number 1. Rising interest rates. Over the last 2 years, the Bank of England has aggressively raised interest rates to combat persistent inflation. What began as a small adjustment has turned into one of the steepest rate hikes in modern UK history. For home buyers, this has changed everything. A mortgage that once cost £900 a month can now exceed £1,500, pushing many potential buyers out of the market entirely. These higher borrowing costs mean fewer people can qualify for loans, and those who can are often unwilling to take on such heavy financial pressure. As affordability collapses, demand for homes has cooled sharply, leaving sellers with no choice but to lower their asking prices to attract attention. The ripple effect extends far beyond new buyers. Homeowners with variable rate mortgages are now paying hundreds more each month, squeezing household budgets already weakened by inflation. This pressure forces some to sell sooner than planned, creating a surge in listings just as demand weakens. The combination of desperate sellers and cautious buyers results in a perfect storm of declining prices. Banks, too, are becoming more selective, offering fewer attractive fixed-rate deals, which keeps buyers hesitant and market activity sluggish. For the housing market, this is not a short-term setback. Rising interest rates change long-term psychology. People begin to see property as a risky investment rather than a guaranteed path to wealth. Investors who once saw housing as a safe asset are now diverting funds elsewhere, waiting for stability. The rate hikes have not just reduced affordability, they've shifted sentiment. When confidence fades, transactions fall, and prices inevitably follow. This single factor alone has become the foundation of the current housing downturn, setting the tone for the sharp price drops witnessed across the United Kingdom.
Number 2. Cost of living crisis. The ongoing cost of living crisis has struck the average UK household harder than any market correction could. Everyday essentials, from food and fuel to electricity and heating, have seen record price surges over the past 2 years. With wages failing to keep pace, people are spending a greater portion of their income just to maintain their daily lives. The psychological shift is powerful. When families worry about keeping their homes warm or their fridges stocked, the idea of buying a new property fades quickly. Financial survival outweighs financial ambition, and that change directly drains momentum from the housing market. The crisis has also crushed consumer confidence, an invisible force that drives most economic activity. Even households that could technically afford a mortgage hesitate, fearing future instability. Energy bills that fluctuate every few months, rising council taxes, and uncertain job markets all create a sense of hesitation. Many potential buyers have chosen to delay major decisions, waiting for prices to fall further or for clearer economic signals. This cautious behavior reduces demand, leaving sellers competing for fewer interested buyers. As listings remain unsold for longer, prices naturally drift downward. Meanwhile, the rental market has intensified the squeeze. With more people choosing to rent instead of buy, landlords have raised rents dramatically, pushing disposable income even lower. For first-time buyers, saving for a deposit feels nearly impossible, further shrinking the pool of active buyers. The cost of living crisis does more than slow down transactions. It reshapes priorities. When daily life becomes expensive, the dream of homeownership becomes a distant goal, not a near plan. As millions tighten their belts, the housing market feels the chill, deepening the nationwide price decline that shows no sign of ending soon. Number 3. Mortgage lender tightening. Over the past year, mortgage lenders have grown increasingly cautious, reshaping the housing landscape in ways many did not anticipate.
After witnessing defaults rise and economic volatility increase, banks and building societies have adopted stricter lending standards. This means even those with steady incomes are finding it harder to get approved for a loan. Credit checks are tougher, income proofs are more demanding, and many lenders now require larger deposits to reduce their risk exposure. As a result, thousands of potential buyers are being filtered out of the market before they even begin the process, leading to a visible slowdown in property transactions. For those who do qualify, the deals on offer are far less appealing than they once were. Fixed-rate mortgages that were available below 2% in 2021 are now hovering around 5 to 6%, drastically altering the cost of ownership. This sudden change in affordability discourages new entrants, particularly first-time buyers who already struggle to save amid rising rents and inflation. The tightening doesn't just impact individuals, it affects entire property chains. When fewer buyers secure financing, sellers have to wait longer or lower prices, creating a domino effect of hesitation and devaluation across the market. This cautious approach from lenders also stems from broader uncertainty about economic growth and job stability. Banks are wary of overexposure in a potentially unstable market, preferring to protect their balance sheets rather than fuel another credit bubble. The result is a slower, more restrictive lending environment that strangles demand at its core. Every rejected mortgage application represents a lost sale, and every lost sale pushes prices further down. What once was an accessible pathway to ownership has become a narrow gate, guarded by strict financial scrutiny that leaves many would-be buyers standing outside.
Number 4. Oversupply in some areas. While demand is shrinking, certain regions of the United Kingdom are facing the opposite issue: too many properties on the market at the same time. Developers who began large construction projects during the pandemic boom are now struggling to sell newly built homes. Towns across the North and Midlands, as well as several commuter zones around London, are seeing a wave of unsold listings. Buyers have become selective, and with interest rates high, even those with the means are negotiating aggressively. When homes sit unsold for months, sellers are forced to cut prices repeatedly, creating a visible downward pressure across entire neighborhoods. This oversupply isn't just about volume, it's also about mismatched demand. Many new homes are priced far above what local buyers can afford, leaving large developments half-occupied. Investors who once snapped up such properties for rental purposes are now pulling back, citing weak returns and rising maintenance costs. As these properties remain on the market, competition among sellers intensifies, with each one trying to undercut the other to attract limited buyers. The imbalance between supply and genuine demand has become one of the strongest structural weaknesses in today's housing market. Local economies feel the weight of this shift. Empty or slow-selling developments impact small businesses, reduce construction jobs, and signal to banks that the area carries higher risk. That perception limits future lending and keeps new investment away. When supply outpaces realistic demand, price corrections become inevitable. What was once a sign of growth, cranes in the skyline, new estates rising, now symbolizes overconfidence. The market saturation created during the boom years has come full circle, transforming what looked like prosperity into one of the key drivers of the UK's accelerating housing price decline. Number 5. Decline in buy-to-let investors. For decades, buy-to-let investors were the lifeblood of the UK housing market. They bought properties in bulk, rented them out, and fueled both price growth and construction demand. But that era is now fading fast. A mix of rising taxes, stricter regulations, and higher mortgage costs has made the business far less profitable. The government's decision to reduce mortgage interest relief and impose heavier capital gains taxes has eaten deeply into landlord profits. For many small investors, the numbers simply no longer make sense. Instead of expanding their portfolios, thousands are now selling their rental properties, adding more supply to an already weakening market. The result is a double-edged effect. On one side, rental prices are soaring because fewer landlords are entering the market. On the other, as these investors sell off their homes, the number of available properties for sale jumps, pushing house prices lower. This creates a confusing environment where renters are squeezed, yet home values still fall. For potential investors, this is an alarming signal. A once safe sector now looks unstable, with uncertain returns and growing regulatory risks. Larger investment funds have also started diversifying abroad, looking for markets with fewer restrictions and better rental yields. The shift is also reshaping property geography. Regions once dominated by landlords, like parts of Birmingham, Manchester, and London suburbs, are now showing visible slowdowns. Estate agents report more ex-rental homes entering listings each month. This gradual withdrawal of investor confidence changes market psychology. When professional buyers step back, sentiment collapses among ordinary homeowners. The buy-to-let exodus doesn't just reduce demand, it removes the competitive bidding energy that once drove rapid price gains. Without that layer of investor activity, the housing market feels emptier, slower, and far more vulnerable to further decline.
Number 6. Wages not matching property prices. For many years, UK house prices have grown far faster than average wages, creating a massive gap between what people earn and what homes cost. The average property now costs over 8 times the average annual income, compared to just 3 or 4 times in the early 2000s. This imbalance has reached a breaking point. Even with long-term savings or help from family, many potential buyers simply cannot afford deposits or meet the income criteria for modern mortgages. As affordability collapses, buyer participation falls, and when fewer people can buy, prices inevitably start to drop. This mismatch affects every layer of society. Young professionals who once aimed to buy in cities are being priced out and forced to rent indefinitely. Middle-income families that might have upgraded to larger homes are now holding back, wary of overextending their finances. The market becomes stagnant when there's no movement between these groups. Fewer first-time buyers mean fewer sellers can move up the chain. Builders, too, are slowing new projects because demand no longer meets price levels, deepening the cooling cycle. The entire system depends on affordability, and that foundation has cracked. The emotional and social effects of this wage-price divide are also significant. Owning a home, once considered a symbol of stability and success, now feels unreachable for millions. As frustration grows, the sense of urgency to buy weakens, removing one of the housing market's biggest drivers, fear of missing out. Without rising incomes or policy reforms to restore balance, the gap will only widen. The disconnect between earnings and property values isn't just a statistic, it's a long-term drag on confidence, demand, and price growth across the United Kingdom's fragile housing landscape.
Number 7. Economic uncertainty. The broader sense of economic uncertainty hanging over the United Kingdom is another powerful reason house prices are sliding so quickly. From lingering Brexit complications to sluggish GDP growth and global instability, confidence in the UK's economic future has weakened dramatically. When people are unsure about the direction of the economy, they delay big financial decisions, and buying a home is one of the biggest. Businesses are cautious about expansion, job security feels shaky, and consumer sentiment has dropped to multi-year lows. In an environment like this, even a small shock can freeze the housing market almost overnight. Potential buyers are especially sensitive to news about interest rate changes, political instability, and trade disruptions. Each negative headline amplifies fear that prices could fall further, causing more people to wait rather than buy. This collective hesitation creates a feedback loop. Lower demand leads to falling prices, and falling prices reinforce the fear of further decline. Economists call this a confidence spiral, and once it starts, it can take years to reverse. The housing market, which thrives on optimism and momentum, now faces the opposite, a cycle of doubt and restraint. Investors, both domestic and foreign, are reading the same signals. Many have already shifted their money abroad, targeting markets with stronger growth and clearer political stability. Even long-term homeowners are beginning to question whether property is still a reliable store of value. When optimism disappears, the flow of capital follows. The UK housing sector, once a global symbol of steady returns, now stands vulnerable to every policy misstep or market rumour. This sustained atmosphere of economic uncertainty continues to undermine both buyer confidence and price stability, making recovery a slow and fragile process.
Number 8. End of pandemic boom. The housing surge that followed the COVID-19 pandemic was extraordinary and also unsustainable. Government incentives like the stamp duty holiday, ultra-low interest rates, and the sudden desire for more space drove a historic buying frenzy. People rushed to purchase bigger homes, rural retreats, and second properties while borrowing was cheap, but that boom created a bubble. When the incentives ended and rates climbed, the momentum vanished overnight. What we're seeing now is not just a slowdown, it's the market correcting itself after an artificial period of demand. Prices that were inflated by panic buying and short-term policy boosts are now adjusting back to realistic levels. During the pandemic, remote work and lifestyle changes gave people a reason to move fast, often without negotiation. That urgency has evaporated. With offices reopening and financial pressures mounting, many buyers are rethinking their long-term plans. The emotional fuel that once powered record-breaking sales has burned out, replaced by caution and fatigue. Homeowners who bought at the peak of the frenzy are now facing negative equity, especially if they overpaid for properties that have since lost value. These stories spread quickly, discouraging others from taking the same risk. Builders and developers are also feeling the aftershocks. Projects that were planned during the boom now struggle to find buyers in a cooled market. Construction slows, layoffs increase, and sentiment weakens further. The post-pandemic hangover reveals how much of the recent price growth was built on short-lived stimulus rather than sustainable demand. The result is a natural but painful correction, one where the housing market is shedding the excesses of its pandemic high and realigning with a far harsher economic reality.
Number 9. Falling foreign investment. For decades, foreign investors played a major role in supporting UK property values, especially in London and other high-demand cities. Wealthy buyers from Asia, the Middle East, and Europe viewed British real estate as a safe and profitable investment. However, that tide has turned. Over the last few years, a combination of higher property taxes, political instability, and currency fluctuations has made the UK far less attractive to overseas investors. The once favourable exchange rate advantage has faded, and many now see better opportunities in emerging markets or in more stable European economies. As foreign demand falls, entire segments of the market, particularly luxury and city centre developments, are losing their key buyers. The decline in overseas investment doesn't just affect luxury homes. When the top end of the market slows, it creates a ripple effect that reaches lower price brackets. Developers who once relied on bulk purchases by international buyers are now left with unsold stock, forcing them to reduce prices to attract domestic interest. This triggers a chain reaction. When new build prices fall, nearby resale properties must follow to stay competitive. In cities like London, Manchester, and Edinburgh, the slowdown in foreign capital has left agents struggling to close deals that would have been instant just a few years ago. Political uncertainty has also contributed to this retreat. From Brexit complications to unpredictable tax reforms, investors no longer view the UK as the same safe haven it once was. The introduction of tougher ownership transparency rules and foreign buyer surcharges adds more barriers to entry. As a result, billions in global capital that once flowed into the British property market has been redirected elsewhere. With this international withdrawal, demand at the upper and middle tiers continues to weaken, accelerating the overall decline in UK house prices.
Number 10. Shift in lifestyle and priorities. The modern housing market is also being reshaped by a quiet cultural transformation. People's values and lifestyles have changed, especially since the pandemic. More individuals now work remotely, travel frequently, and prioritize flexibility over long-term commitments like mortgages. Younger generations in particular see home ownership less as a goal and more as a financial burden. Rising maintenance costs, high property taxes, and the fear of being locked in to one location have made renting or even living abroad more appealing options. This shift in mindset means fewer buyers are chasing homes, leading to softer demand and slower sales across the country. The dream of owning a suburban home with a long mortgage is losing its shine. Many now prefer mobility and experience over ownership, investing in travel, education, or digital lifestyles instead of property. Remote work has also diluted the need to live near big cities, reducing pressure on once competitive urban housing markets. As families move to smaller towns or even out of the UK entirely, large metropolitan areas are seeing excess supply and price stagnation. The psychological desire that once made people stretch their budgets for a home has weakened, and that emotional cooling is quietly reshaping demand patterns nationwide. For the market, this represents a deeper and longer-term challenge. Housing cycles usually recover when confidence or affordability improves, but cultural shifts don't reverse easily. A generation that doesn't see property as essential will not rush back into the market even when prices fall. The shift in lifestyle and priorities is slowly eroding one of the UK's strongest economic traditions, the belief that owning a home equals success. This evolution in values might be the most lasting reason why house prices are not just falling fast, but may stay subdued for years to come.
The rapid fall in UK house prices isn't just a market adjustment, it's a reflection of deeper economic and social change. Every factor from rising interest rates to shifting lifestyle choices has chipped away at the foundation that once made property the cornerstone of British wealth. The market that once thrived on confidence, cheap credit, and tradition now faces an era of realism. Buyers are cautious, lenders are strict, and the mindset of an entire generation has evolved. The dream of guaranteed growth has faded, replaced by questions about stability, affordability, and long-term value. Yet, in every decline lies an opportunity. Lower prices may open doors for new buyers, and smart investors who understand the changing landscape could shape the next cycle. But the recovery will be gradual, built not on speculation, but on sustainability. The era of easy property profits is over. The age of balance has begun. If you found this breakdown valuable, hit the like button, subscribe for more economic insights, and share your thoughts below. Do you believe UK housing will bounce back, or are we entering a new normal? Your opinion might spark the next big discussion.